but we're going to go through and review our predictions for last year and show you what we got wrong and if we got anything right. And then we're going to, at the end, take you through our individual predictions for next year. So I think I'm the first one here. I'm the one who's going to go first here, and I listened to this podcast the other day to see what I had predicted because I completely forgot, and I'm dreading this now. Go ahead.
So I've got Paul's predictions here written down. He made 3 predictions, one of which is correct, which is better than either me or Steve. Unfortunately, the one that's correct is not a stock market prediction. So it was on this show about a year ago, or the equivalent of the show a year ago. It was actually a New Year's Eve show, I think, rather than a New Year's Day show, because that's when the Sundays were. He pointed out I had announced that I was about to become a dad, and he correctly predicted that I would hate my life as a result. So 1 for Paul along the way. You will see a general theme coming through from me with everybody's predictions that I will be looking for positives because they're mostly wrong. All of ours are mostly wrong, Paul's included. But I think I'm going to look for positives or things that I can find. So, well done, Paul. That's 1 more than probably the rest of us. But Paul's sort of stock market predictions, one of the things he said was, quote unquote, some EV stocks will double. And he had Tesla to split adjusted. He said if it doesn't split, $1,600. His exact words at the end of it were, "I'm going to die on that sword, aren't I?"
And I feel it thrust through my heart right now. I feel that thrust through my heart.
Well, the stock is currently at $122, but it did split this year. It split 3 for 1. So Paul's looking for it to roughly double, I think, from the start of the year, and it's just under halved. At the time, you mentioned stuff like factories coming online in Germany and China and so on and so forth. And actually what we saw was a kind of the other Elon Musk, the Elon Musk that gets distracted by doing things like, well, trying to buy Twitter and then trying not to buy Twitter and then, in fact, buying Twitter and then using Twitter and mostly Twitter, to be honest. But you did say along the way some EV stocks will double, and I found this quite difficult to verify because I couldn't find any, but I don't know all the EV stocks, so maybe there are some that doubled. You could be right about this. I saw Rivian down 81%, Arcimoto down 97%, and Canoe down 86%, and then I got bored of looking at them. So maybe some have doubled. You could be right about that. I can't definitely say you were wrong on that prediction, Paul.
So I think how am I going to defend this? It sounds stupid. I'm going to say it was poorly thought out. I thought I think at the time.
How am I going to defend this? I'm an idiot.
I think that's how I defend everything that I ever do. No, I think I think at the time I thought the hype was still there, and there was still a tailwind on the EV sector, and I thought people like Elon Musk were still going to use their catalyst, and I think we explained this in last week's show as well. They were going to use their catalyst to continue the hype. But what we found in 2022 is a macro change. Everyone losing faith in Elon Musk because he did some dumb shit, and the steam ran out on the catalysts. All these catalysts happened, by the way. The Semi came out, the Gigafactories came online. Tesla has not failed in its sales targets. It's come very slightly short, but it has not failed in keeping up that 27% a year growth. So the fundamentals are there, and I think my thesis on mean reversion is still coming true. But I did think this year, for this very specific year, I thought it was going to do very well.
Well, you'll find that's a running theme in any sort of commentary or predictions you made on that show, Paul, because I think you thought we were probably another year out, or maybe 2 years out between a problem. So you were still bullish on the macro. What happened was macro basically killed all of your predictions in one fell swoop. So let's move on to the next one. No, let's not spend too long.
And us as well.
Yep, I take the same point on this for what it's worth, but Paul's other prediction was Bitcoin was going to quote-unquote shoot off in January. I didn't know quite what that meant, but he did point out that this is one that we could check pretty quickly. We didn't need to wait the whole year for that, but he subsequently said it's either going to have a big shoot-up by maybe 100% in mid-January, or it's going to completely collapse. Now we begin to arrive, because at the end of the year, Bitcoin is down 60%. But what happened in January is the question. Yeah. Well, it went down. It rallied again around March, April, back to roughly where it was at its start of year levels, but I'm struggling to find much that's positive on that one, other than the either or is correct, because it did indeed pretty much completely collapse.
See last week's podcast for my for all our opinions on Bitcoin at the moment. But yeah, completely wrong. I was following the trading scheme at that time, and no, absolutely not. Full of shit. All the trading is dumb. Keep to your fundamentals and keep to your discounted cash flow models, please.
Again, this is another one though that there's just the macro snookered one, really, isn't it? This Bitcoin run up was basically excess cash being thrown into into crypto, because crypto was seeing big returns at the time, and that all finished rather quickly towards the sort of mid to end of January. I think it went 10% down and then 61% down. So unfortunate.
I wanted to mention that actually I've been affected by macro as well, because I am not going to hit my ISA target this year. I've looked at it and I'm $9,000 short at the moment, and I'm only going to be able to find 5 to go in. That other 5 has actually now been put in my NatWest account, which is paying a 5% interest rate on the year, and I figured that's a pretty good. I had to build up my emergency fund as well. So that is now going to be part of my emergency fund. But I have decided to make that move. I've not managed to put in my full 20,000 in the year this year, because I've diverted some to high interest rate savings account for my emergency fund. So very interesting that the macro has made a move on me almost unconsciously.
So I've got Steve's predictions from last year, and we'll start off with the first one he made, and it was that the S&P returns were to be 11%. He said that he expected they'd not be the worst hit. And unfortunately, Steve made a prediction on interest rates during that, and they went a lot higher than he expected. Essentially, I think he was expecting a pretty much half the range of what we're going to end the year on. Paul unfortunately chimed in and said, "There's no bubble, and it won't.
I agree.
The bubble won't pop. It won't pop for 2 to 3 years. There's going to be a further extension of pricing." So the bubble did pop. I think the S&P, I'll just have a quick look at it now, is down, as we speak, 20.14%. So 20% down. So 31% percent miss on that one, Steve. I didn't think this was the worst prediction at the time.
No.
What do you think?
No, I was going with the idea that the Fed were talking about a raise to about 1% of interest rates, and I thought, okay, interest rates are what's going to drag stock prices, but I don't think 1% is going to do very much. In fact, what we've had is 6%, and if you'd said rates are going to go to 6%, I would probably have not taken that prediction, but such is the nature of predictions and so on. So that was, as you rightly point out, where I went wrong on that. I was paying a lot of attention to forecasting rates for 1% by the end of the year, not 6%.
I think really your two predictions were hampered by the war. I think the war was a disruption in the middle of where we thought inflation was starting to slow, or heading towards maybe starting to slow, and then the war just kicked it on a little bit more because it raised a lot of commodity prices, especially in Europe, and things like oil and gas and what have you. So that was that's my partial credit to you, Steve, because one of your other predictions was that US CPI would be below 3% at the end of 2022. We thought, I think me and you shared this thought, though, that this was a supply side inflation problem, and that this would remedy itself, and unfortunately that didn't happen. Thoughts?
It was a money supply problem.
It was a money supply problem. It's very kind of you to suggest this has anything to do with the war, which, to be honest, I would give myself a pass for not predicting the war on that. What I'm less likely to give myself a pass for is not understanding that inflation wasn't just about. I was expecting supply shocks, basically, from shipping unwinding, providing parts and cars and stuff were going to appear like madness, causing supply gluts, and that never happened. What happened was there's too much money knocking around. That's why not even close on this.
Too much demand. So your last one, Steve, was that you thought Blackboard would be acquired, and this was my fault because I said you had to pick a stock that would be acquired. They weren't acquired, but they did sack the vast majority of their management team. It looks like they've had a whole new C-suite put in. So is that potentially being brought in to get them ready for acquisition?
Yeah, you began with, I thought these guys were going to get acquired. I didn't think these guys were going to get acquired. You said I had to find someone to get acquired, and I picked these because I thought they were most likely out of all the people I don't think are getting acquired. I did say, I think, on the show, I wasn't having Peloton or Pinterest or something I'd already heard talk of. I'd have been wrong with those as well. So, yeah, I'm wrong on Blackboard, for what it's worth. But Clear Lake Capital in October are an investment firm who have an 18% stake in Blackboard, and they switched themselves to activist from passive before, and they have a history of having done something similar. Blackboard, by the way, is an educational or social good software firm. They've pulled a similar trick with Cornerstone On Demand, which they subsequently took private by taking a stake, then becoming activist, then buying the thing outright. So I wonder whether I might just have been early on that. And look, early is wrong. Paul's share price call is on Tesla is wrong because it's early. It will get to 1600 split adjusted, but you don't get the points if you're right in 3 years' time. I kind of Blackboard, by the way, are defending their thing with the poison pill approach, so they may well not get taken over. But I was closer than I thought on this, for what it's worth. I mean, I was going for that because I was trying to work out pretty much from scratch and with nearly nothing to go on. But this may happen this year or next, for what it's worth. It's not one of my predictions for this year because I didn't have to think of a takeover target, so I didn't.
Lovely stuff. So, Steve D, I've got your predictions. Are you ready for this? I'm sure you know them. So you first predicted that inflation was going to return to normal by the end of 2022. Obviously, what is? I mean, we can choose UK or US inflation. It's still above 8%, is it, or is it 7% right now in the US? How do you feel about that one?
Well, I feel particularly aggrieved because I made a very terrible prediction. I actually thought that because shipping rates were already coming down, I thought that commodity prices were already coming down, that these were going to be the vast majority of the problems. But in fact, inflation got considerably worse after we predicted this, which obviously doesn't help when you're thinking about things at the beginning of the year and you think we're at the top now, so we're going to start to see them coming down, and then they get much higher. You've always got a problem when you're predicting rates to come down a little bit. So I think that was a particularly bad call. Although I have written on my piece of paper for some reason partial credit, so I wonder how I'm going to get to that get to that partial credit. But I suppose inflation is coming down as we speak right now. So maybe I was just 11 or 10 months too early.
Yeah, sort of like right outcome, wrong process, right? I was wondering if it was the specific thing. was it in the places that you thought it would be? As in, so you're very hot on the lumber prices and things like that because of the industry you work in, but obviously it was housing and fuel and things that actually went up.
Well, that was the thing. I was going to say, Paul, you did actually remark that you'd just been on the Lennar call and they were very confident of a successful year.
Yes.
Obviously, that only happened for them for the first half of the year, by which point interest rates were a massive problem. So, look, inflation, the commodities came down in the places I expected them to come down. It was just that all of the other areas I didn't expect to stick around, stuck around. So there's not really a lot you can say about that. When I thought the driving factor was the shipping problems, they were driving a lot of cost inflation on a lot of goods. I thought the problems were commodities. Once they came down, that I thought that would ease the whole package. Unfortunately, that just didn't happen.
Okay, it gets a bit worse. So ARC was set to outperform in 2022, were they, Steve?
Yeah. Well, see, look, at the beginning, I thought this ARC portfolio was a lot better than it is today. So I'm gonna give myself a little bit of somewhat of a freebie.
Yeah, I'll give you that.
The quality of this portfolio has dipped massively over the year, and at the beginning we didn't. If you're factoring in the fact that we thought inflation was going to be, that inflation was going to be transitory, then interest rates wouldn't get so high, and all of the stuff in Cathy Wood's portfolio, wouldn't have as many of the problems as they actually experienced during the year, which ended up being quite massive problems. But twofold problems with ARK is that the companies they've got are susceptible to interest rates going up. That makes them a less propelling proposition. The other thing is that she's made these portfolios, or I feel she's made these portfolios considerably worse. So, it's a two-pronged wrong on that one, if you like.
That, I thought, was your kind of issue, Steve, for what it's worth. I mean, you were looking at the bits of what you considered to be quality in there and thinking, look, that will stabilise this portfolio and it will turn around and do okay. Unfortunately, the Cathy Wood way is to double down into your high-conviction holdings, which are not the ones that you like. They're the ones that are, well, strictly unprofitable, depending on how you measure profitable. So it actually ended up getting worse and worse and worse.
Fair enough.
Yeah, and finally then, and one I think it's still on the cards, and I think it's still possible. Boohoo and ASOS, or Boohoo or ASOS, will be acquired by X company. That hasn't happened this year, and of course Boohoo and ASOS have both dropped, must be over 60% each at this time. I'll quickly get those up in a minute.
I would guess, off the top of my head, it's nearer 90%. They've rapidly depleted in value, to the point where, at the time, I thought they were kind of pocket change to any kind of American company that wanted UK with some US distribution, but now they really are pocket change to some UK and US companies that want that kind of distribution. But I would say partial credit maybe is due for this one, because Sports Direct have recently taken up quite a sizable chunk of ASOS. I think they've bought about 5% of it, which is normally a sign that someone's about to go bust, because Mike Ashley only seems to buy companies that go bust. He's sort of like, it's kind of like being stuck on his watch list. I don't actually think ASOS or Boohoo are in any immediate issue. In any immediate issues, I don't think they're going to go bust overnight.
Doesn't
or
look
anything like that. But I think this is just another one of those where perhaps we're a little bit early, and this could become a Fraser's Group product next year.
According to Google, Boohoo is down 70% this year, and ASOS is down 77% year to date. So not as bad as you thought, but they are pretty big. I mean, some of the bigger stocks, Tesla has lost more in value, but obviously less in percentage share price, by a fraction, but these ASOS and Boohoo were definitely two companies which looked very good in the retail space in 2021. That's why their prices shot up quite considerably, arguably they still remain cheap at that time, because I agreed with you. I felt exactly the same thing, and I reckon we're early. I reckon you're early on this one. I reckon something's happening, and it might be that they're just. It's possible that these high-ish quality companies that have lost all this value recently are just part of a larger group of companies that have lost a lot of value as well. It's similar thing to what Steve W was talking about earlier. There's lots of shiny things on the market right now, and it would take a lot to ignore Amazon and Google and things like that and end up acquiring something quite small. I mean, obviously, if you're Sports Direct, that's what you're looking for to get your acquisition. But still, I think there's a lot of shiny stuff out there that maybe these companies think are a lot cheaper.
Well, it's more than that as well, though, isn't it? It's not been a huge year for M&A either, as I've not seen an awful lot of deals going through. I've not seen. I mean, this is the time when you want your companies to be starting to look at looking at buying, other companies to tack on and make their product even better. But the companies we were thinking about at the time were the companies like Twilio could go to be a part of Salesforce, because that makes an obvious kind of choice. Now, that would have been a really bad bit of M&A to do in January, because you'd have paid 20 odd billion for Twilio, but today you're paying about 9. So it makes sense that these companies have just held off and said, let's let these valuations fall a little bit, and then maybe 2023 will be the year of M&A. I wish I'd have thought of this an hour ago when I was writing up the M&A thing. That's probably what I would have said. It'd be a bigger year for M&A, maybe be a bigger year for IPOs, but there's been none of that this year. It's been a very, very quiet market.
Yeah, I was thinking that in a falling market, people tend to think, well, let's just hold steady on the M&A. We might get this cheaper next month, next year. When things are ripping higher, it's the case if you buy it now for this, or you buy it for 1.5 times this in 3 months' time. I wonder whether that slows things down. It's the wrong way round, right? But I wonder whether that's how you think.
It's incredible to see all the mergers, all the SPACs, all the acquisitions that happened in 2020 and 2021 when everyone thought stuff was going somewhere. And even now, the people at the top of these companies who we trust with our money are paralysed by what's happening in the macroeconomic market. It tells you something, isn't it? The human behaviour and that behavioural finance, that behavioural investing is out there, and it affects everyone, even the people we think are immune to that.
I mean, what has been nuts though is that the little M&A that has happened at massive premiums. So I've been looking at a few, as you know, I reported on Thoma Bravo, but they've just bought another company whose name escapes me at the moment, but they bought it at a 70% premium, which seems like a lot. I mean, like some of the stuff in my capital incinerators, if you told me you were giving me a 15 or 20% premium, I'd have snapped your hand off. So why they're choosing to add such a massive amount to these share prices to get them through? I wonder, like, because what I've seen is a lot of the sort of like companies that you were hoping the CEO, the founders, had the sort of stomach for this kind of activity have tended to not have the stomach, and they've just kind of sold the company off to, you know, the 20% premium or a 30% premium. But then Thoma Bravo just coming along and going like 78% premiums and 58% premiums, and it all seems like they were almost like stuck in 2021's acquiring, where you were acquiring at far too high a price, where, you know, Teladoc was acquiring Livongo for 18 billion or whatever, and now the combined company's only worth like 6 or 5 or 4 or whatever it is at the moment. It feels like it's a little bit still. I do wonder if the premiums are a little bit high.
I mean, I hate to point out the obvious ones, but Microsoft buying Activision, that's still ridiculously high for. I mean, it's quite a good value stock at the price it was, but it's still quite a lot higher than it should be right now if they just waited a couple of months. I mean, Elon Musk buying Twitter is another very obvious, stupid buy. It's possibly worth only 20 billion now, rather than the 54 or 45 billion that he actually bought it for. So it's probably worth less than 20 billion now. And Adobe bought, you'll remind me of the company that they bought.
We talked about it on the show, but yeah, Figma
for a ridiculous amount of money as well. And so these are the obvious ones, and I think they prove your point. I think they prove that M&A is still done by the big boys, but really poorly. There's hardly any ROI on some of these, or positive ROI on these investments right now. And for Microsoft, it could go really wrong.